Okay, so this should be recording, and if everything goes well, or even if it doesn't go too well, I'll maybe upload this to YouTube. So can at the beginning, can we all have our mics muted? That goes for Hugo, and we'll start. Oh, this is public speaking, terrifying. Um,
We're among friends, no worries.
what? We're friends, no
We are
worries.
among friends, exactly. We are
Yeah, yeah,
among
yeah.
friends, so no worries.
Of course, but if I want to upload it to YouTube, it might be like forever shown how
That's true. Yeah.
whatever. So okay, let's start. Oh, dang. So I Robert chose a title for my talk, which was like something different. The title, or what I want to call this talk, is blockchain fundamental for beginners. It's given by me. This is a talk that I have already given in UAC, in the State University of Querétaro. Querétaro is a state of Mexico, if people don't know. So it was given to the math department, and there was a lot of math included. There wasn't a lot of math. There was some more math included that I've tried to trim out as much as possible, but it's not possible to completely 100% reduce all of the math, or all of the computer science, all of the cryptography, and I have to admit, and 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 so there's gonna be some parts of cryptography, very simple. No, there's no math actually, and in that part of cryptography. But if you had to like go deeper, there would be some math of it. And this is for people who don't know how blockchain works, who don't know what proof of work is, proof of stake is, and to get like a basic fundamental understanding of how blockchain technology works, and how it's just like a flavor of something called zero knowledge proofs. So a little bit of context. This is an image that I stole from Alex, someone who's in the call here, a cousin. And well, the context is 2008, the economic crisis, the housing crisis, and as as a reaction to that, Satoshi Nakamoto, an alias, comes out and gives us Bitcoin. Gives us Bitcoin, which has internally this thing called proof of work, and it's a way to have information in a decentralized manner and have it consistent and validated. That's a hand wavy sort of kind of explanation, but so how are we gonna try like to get the point across? How to get proof of work across? We're gonna do like a sort of experiment or example where we're exercise. Exercise is a better word. So we're gonna implement our own bank, right? Our group is called Crypto Investments, and it's a WhatsApp group. And so we'll do the Crypto Investment Bank, and it's short for the short form will be CIB, just because it's a fancy name. And in this example that we're gonna work out, or this exercise we're gonna work out, the actors are gonna be Robert, Becky, Toño, myself, and minors. They're gonna be minors. So the first implementation of our bank is gonna be a very simple and stupid implementation. It's gonna be just a ledger, a piece of paper. Maybe we'll put a title like this one, accounting CIV, and we'll just put transactions there, right? Robert deposits blah. Oh, and some of those words are gonna be in Spanish because I was lazy enough. I wasn't. Yeah, I was lazy and changed it to English, but it's not. They're not important parts. The parts that I haven't translated. So in this ledger, in this bank, in this very stupid bank, there's gonna be a piece of paper. That piece of paper is gonna live here in my house, and there we're gonna write like transaction. Robert gives Daniel 100 pesos. Robert gives Becky 100 pesos. Okay, and okay, this sort of solves the concept of a bank. There's information, and there's information about who has what, and who gave what to whom, and it's very insecure, right? There's a lot of problems with it, but I can see a ton of problems with it. But the first problem that comes to mind is that I can do fraudulent transactions. I can just write, Toño gives 2 million pesos to Daniel in the ledger, since it lives here in my house, and it will be a valid transaction. But that will be fraudulent, and we don't want that, right? We don't want me being able to get funds from Toño without Toño giving consent of such a transaction. So there's the first thing we're going to introduce is cryptography with 2 keys, right? This is a very cryptography in a general sense is something that everybody sort of knows that exists. For example, in wars, in World War II, in all wars, they have to like get messages from one place to another place and make it in a secure way, right? And with 2-key encryption, this is the known paradigm, or the known case, right? There's this information that Bob wants to send to Alice, and once it crosses this line, this is like the internet or whatever medium you want to see, but that's a medium that can be spoofed, that can be heard from, or like it's open to other eyes, right? Not only to Alice's eyes. So you can have a message, grab Alice's public key, encrypt the message with Alice's public key, send it through the medium that's spoofable, and then Alice privately at her computer or whatever method, she'll use her private key, which should be private, completely secure and secret, unless you want to get hacked, and then read the message, right? So that's like to send secure information. We can have also 2 private keys, the 2-key encryption, to validate the source of the information. That will be like this type of thing, right? In this case, Bob wants to know that Alice is actually Alice, right? So Bob is gonna say, okay, Alice, please sign me this message. This message is gonna be hello, Bob. And Alice says, okay, sure. I'll grab my private key. I'll append the message to the cipher to the encryption of that message, and then I'll send it through the medium, through the internet or whatever. And then Alice's public key can be used to verify that it is indeed Alice who signed that piece of information. Right? That's not such a common case. The most common case that we see in real life or whatever, or when one thinks of 2-key encryptions, is the first one where you want to send information, but there's also this other one that is to sign information, and this signing information is going to be very important for this improvement of our CIV bank. So now, instead of only having like transactions in a piece of paper here in my house, we have transaction and also signatures, right? Signatures are going to be this process that's stated in the image, but it's symbolized here by this like sort of cursive thing, right? So now, if I wanted to write here, Robert sends Daniel 100 pesos, I couldn't be able to do that because Robert has his private key secure and secret, and there's no way I can do that transaction. Okay, so that's an improvement in our crappy bank, but we can still see some problems, right? One problem is just is the centralization of the information. My house could burn down, and the piece of paper where this ledger lives could just be burned, and information will get lost, right? Or I can myself just destroy the information because for some reason I was owing too much to whoever, and I just decide to destroy the information. So that's another problem, right? And a way to maybe solve this problem is decentralization, right? instead of having just one ledger in my house, we're gonna have a copy of the ledger in Robert's house, a copy of the ledger in Antonio's house, a copy of the ledger in my house, right? And everybody's gonna have the whole complete transactions, and that way there's not gonna be a single point of failure where the ledger could be destroyed or modified. And this is fine, but there comes like a problem, right? How do you deal with the synchronicity of the information? You not only have to have the ledger, you have to have the same ledger in all of the houses, in all of the places. How we sort of we sort of destroy the problem of centralization, but this decentralization gives us other troubles, right? So in this case, like how it will work, it will be like Becky sends a message, the transaction. What happened? Okay, this okay. Becky sends a transaction. Becky wants to send Toño 2 pesos, right? So she signs it in her own ledger, and then emits that transaction to the rest of the people, and people should like write it in their own ledgers, and so that sort of happens in this crappy animation. And more problems will come from this, right? So now I have to talk about the second mathy or computer science or cryptography related thing. It's only the second or the only other thing needed. The first one was two-key cryptography. The second one is these cryptographic hash functions. What's a cryptographic hash? So in the case of two-key encryption, there was a way of encrypting and then decrypting the information, right? This is a one-way encryption. If you have a message, this, for example, this message to be encrypted, you can encrypt it. Let me. You can encrypt it with this function, with this cryptographic function, but you cannot take it from here, like having this information, these ones and zeros, and be able to know what the original message was. That's the whole point of cryptographic hash functions, and this is commonly known as the hash of this string. And it doesn't have to be string, right? It could be like whole ledgers or blocks. That'll be afterwards. So we in the previous, like in the development of our CIV bank, we have this very bad method where Becky just like sends the transactions through the internet and everybody writes it down, right, in their own ledger. But we don't want that. We want that's prone to errors and that's prone to many things that could go wrong. And a way to do that is we have to choose someone who writes the next block of the choose someone, only one person who's going to write the next set of transactions or block, and that will be like the original, the default, not the default, the one that everybody has to follow, right? So to do so, we have to choose the next person who's gonna mint the next block. We do work, and a proof of work, the proof of that we did work to get that to win that position, to be the miner that actually gets to put the next block in blockchain, is through the cryptographic function, right? So this is a representation of a whole of a ledger, of a block in the ledger, and there's this like noise below, right? There's the transactions. I only put one here, but imagine that there's a lot of transactions, and in this footnote I have my address, me being the miner, and some random noise added, right? If I change this random noise slightly, the hash of this whole thing is gonna dramatically change. If I change it just by one single character here, this number is gonna be completely 100% different, right? And one can change and change and change characters until they get a hash with 20 trailing zeros. For example, this one has 0 trailing zeros, but if this one was a 0, it will be 1, 2, 3, 4, 5 trailing zeros. So one has to work until you get a hash that has 20 trailing zeros. I'm using 20 as a number. Like it could be more or less. I'm not sure what's the exact number, but the point is you have to generate these hashes by changes a little bit this function and computing the hash, and you hit gold or you mint a block when you get the 20 zeros, right? So this is sort of an example. This is block 1, block 0. It only has one transaction, but it should have many. This is block 1. The next block after block 0, and in the block 1 you'll have the hash of the previous block. Like the winner, the one who minted the block 0, he got a little bit of Bitcoin or pesos or whatever the currency is named, because he was able to generate this hash with a specific garbage in the footnote, and it gave it all these zeros. So sort of like to look at what I just said a little bit again, is Becky wants to put a transaction. These are the representations of all the ledgers, each in each node, and Becky sends some money to Robert, and it's in this unfilled block, right? Or maybe it did come into this filled block, and then there's gonna be miners trying to mint blocks so that everybody accepts them as the next block. And what miners are gonna do, so let's imagine that Becky sends information. There's this already filled block, and miner 1 found a solution for block 42. So then, why isn't this working? Okay, what happened again? So miner 1 finds a solution for block 42. That means that it computed the hash function of this block, and he had 20 trailing zeros. After that, why is my animation not working? Well, that should be the second part of the animation. After that, the miner says, okay, I won this. I won the minting of the next block. Everybody listen to me, and put it in your ledger. And people, since they can verify, oh, okay, yes, the cryptographic function of given this hash that the miner sent, it does correspond to a hash that has 20 trailing zeros. So they will add this block to their own ledger, and that's the way that proof of work chooses the next winner for minting a block, and the miner gets a reward, right? It gets a little bit of Bitcoin or whatever. And so a little bit like this is the conclusion part of the talk. And so what is proof of work? Proof of work tries to find a next minter and the next person who's gonna mint the next block, and to choose that next person, it gives you a problem. It gives you it says, okay, there's this block, and you have to do work computing this hash function, the hash function of that block, and changing little things about that block, like the footnote that has the garbage, until you find a hash that has 20 trailing zeros. So So that computation of that hash function is expensive in terms of energy. Right? There's mining sites where people buy a ton of machines, and they're all the time doing these hash functions all the time. The only thing they do is this hash function. They sometimes they're like machines that are only being built to optimize this hash function mechanism, right? And that's very inefficient, right? Proof of work is just one of the flavors of something called zero knowledge proof, and there's other ways of choosing the next minter of the blockchain. There's proof of work, there's proof of memory, there's proof of stake, there's proof activity. There's a lot of zero knowledge things, and proof of stake does not have to compute all those hash functions to do the choosing of the next minter of the blockchain. What they do is they do ownership of a whole pie, the whole stake, and so if there's cryptographic information that you can own part of that pie, part of the stake, and according to what percentage of the stake you own, that's the probability you'll be able to mint the next block. And that's a hand wavy argument of how proof of stake works. With this that I just talked about, proof of work, it's the basics of how to, like, after that you can also build things like smart contracts. What's smart contracts? Instead of the ledger just having transactions of who owes who, or who sends who sent what to whom, you can also have code, right? It's just a string of things. So that code can live decentralized in many places, and that's why it's the Ethereum machine is called a world computer, a decentralized virtual machine. And there's other applications such as decentralized governance and many more things. But because I wanted to keep this short, I think I'll leave this here, and I hope you've liked the presentation. I can talk about other things too, and please ask questions and talk about your own things if you can. Thank you, and please unmute yourselves.
Bravo!
Thank you.
Thanks, Daniel.
Am I still?
Thank you.
I should still be recording. Yes, this is still recording. So okay. Does anyone have any question?
I do.
Okay, Carla.
Yeah. What is the, like, are the people who are creating the chain of zeros at the end, the trillion zeros, are they also reading what the original message
Sure.
was?
They can read what, who sent what, but it's very, very boring information, right? Doesn't matter. These are miners, the mining people who have computers, trying to solve the next block to get a reward from it. I don't know if that's any clearer. Maybe not. Any other questions?
Maybe going back to this investment approach here, especially in this group that we created, maybe you can explain how miners can benefit from this. Like, what's the value chain that is created, and how do they actually receive money? Just to understand what mining is, maybe afterwards, since you are into Cardano, you can explain this process on a proof of stake rather than proof of work. But maybe it's simpler to start with proof of work to see how this value chain actually works.
Well, the value that they're providing the community is having the job to write the next block, right? People want all their ledgers, their personal, since it's a decentralized process, they want their copy of their ledger to be pristine. They want to have the correct information, and the mechanism, the protocol, proof of work, works in a sense that the rules of the game, the rules of the protocol, is that every time I win, as in find the hash function with 20 trailing zeros, or how many you choose to make it, I get some reward. So I get there's some Bitcoin that lives in there's a finite amount of Bitcoin, right? But there's some Bitcoin that has not been emitted yet. And a part of that Bitcoin that hasn't been emitted is gonna be given to the miner. Later, when when all the Bitcoin has been mined, all the transactions are gonna work with what the sender wants to. The sender is gonna have all senders are gonna have to add a little bit of reward to give to the miners, right? For them to keep. The miners are the backbone of the network. They're keeping the network up, and they're working for the next transaction, and the way that it works for Bitcoin is with this hash function, and that's energetically very expensive. It's so expensive that nowadays Bitcoin network spends more than countries in like country sizes of energy, and with I mean I sort of try to explain how it works in proof of stake. Proof of stake, you have cryptographic certainty that you have stake in a so if there's a whole pie, the whole pie of Cardano, for example, you can have like a 1% of that pie, right? So if you there's this little game protocol where the protocol is going to choose by random the next minter of the coin by and the probability of you getting the next minting is 1% if you own 1% of all the Cardano. If you own 2% of all the Cardano, then you have 2%. If you own 51% of all the Cardano, then it becomes problematic, and you might be able to be a bad actor if you wanted to, right? Because you'll get 51% of the blocks you mint. So I don't know if that explained anything, or if you want me to dig into something else.
That's actually the start of it, right? Thomas was asking the question in the last session. I think it was Thomas. What happens? Basically, that's what you answered. What happens when all Bitcoins are mined? Then the transactions actually have to pay for the mining service.
Yes.
But how expensive is that gonna be? Is this actually sustainable in the future? Basically answering the question: is this actually a sustainable way of transacting or not?
Yeah, I'm not worried. I mean, it's if a block is large enough, and you give a very small, it's you already have to pay, like in your bank, every time you do a transaction. You pay it not directly, like the bank will charge it somehow from you, but yes, every time there's a transaction anywhere, there's work to be done, and someone has to get paid, right, for that work to be done. And I'm not worried. I mean, I guess there's like skeptics that will say like, oh, when the Bitcoin stops, when the mined Bitcoin disappears, it might disappear. I don't think so. I mean, I'm not. I don't have any better arguments than a hand wavy argument or just a facial expression saying that it doesn't matter. But okay, I guess that should be fine for now. I could also I've also tried to do some trading a little bit. I could talk about that if you want to. If everybody wants to.
Yeah. Please do that. And well, you are doing staking as well. Maybe you can explain like practically, because again, investment group, right? Practically how staking works. What are the results of your staking, like your real world results, not that what you actually see in flashy in bits or whatsoever, where you can stake as well. Just like your experiences with this.
Okay, so staking is very nice in Cardano and most proof of stake protocols or chains. And there's two types of staking, right? There's like in Bitcoin, there's the miners and there's the users, right? So it's very separated. Here, the miners are there's two type of miners. There's people who delegate their stake, and there's people who are actually have a computer dedicated to minting blocks. So in Cardano, there are a lot of stake pools, yeah, and this every stake pool is a server, a machine in the web or in your computer, listening to this raffle of who's gonna make the next block, and if they hear that they can make the next block, they'll make the next block, right? And they have to do work to that, or I mean, a program does work to do that. But you can be also a delegator. So I can have my Cardano in my wallet, and I can delegate to a staking pool. So now that staking pool that has its own Cardano and my Cardano delegated to them, it's not like I send them the Cardano. That's different, right? That's like sending money to someone else. This is just telling I delegate my decision, or my if I get chosen for the next block, I want this pool to be able to mint it, right? So they will get the benefits, and I get a little bit of the benefits, right? No, not the whole benefit, but a little bit of the benefits, and it comes out like to 6 to 5% per year. And if you are actually a stake pool operator, which I want to be maybe soon, so stay in tune for my staking pool soon enough. But yes, so yeah, the staking pool gets most of the rewards, and you get a little bit of the rewards extra of something that doesn't happen in proof of work, right? Proof of work, only the miners get the people who are not the people like Becky, Toño, Robert, me. They didn't never get like any rewards from anything. They're just users of this ledger that is decentralized, and the miners are working to get some of the some rewards. In proof of stake, there's people like me that do passively nothing, nothing to do, and there's people who own stake pools and win more money. And also, well, that's sort of my answer to the question. And if people are interested in like my margin trades, I can show. I always like to show things, be a little bit open. So I'll bring this up here. I'll start resharing my screen. I'll send that to 8. So I've done 2 trades. They're called. There's this thing called margin account. If you don't know, who knows what a margin account is? Robert knows. Who else? No one else knows what a margin account is.
No.
Okay. So a margin account is a way to bet that the price is going to go up or the price is going to go down, right? When you bet that the price is going to go up, it's called a long. When you bet that the price is going to go down, it's called a short. Now, how having money, if you have pesos, and I think that the Mexican economy is going to go up, how can having pesos I can bet that it's gonna that the price is gonna go up? So like pesos versus dollars, for example, right? A way to do this is I ask for dollars borrowed. I borrow dollars, and then the amount of let's say I borrow $10, and I have to have something called the contingency, right? So I have $10, and I'm gonna borrow $100. I'm gonna borrow 10x from my contingency. The thing I can lose, right? If things don't go my way. So this $100 that I get, that they lend me, I change it to pesos immediately, and in a day or 2 days or how much time you want, when the pesos is greater, then you can sell those pesos and get a profit, right? From the money they lend you $100. You can today, tomorrow, when pesos is a little bit up, you sell those pesos back to dollars, and you'll get something extra, right? You pay back and you keep the extra, and that's how you do a long. That's how the long mechanism works. A short mechanism. Oh, and if you're doing a long and the price goes down, the market goes down, then they will liquidate your long, the contingency, the 10 pesos, as soon as the losses of those $100 become equal, or a little bit less than the contingency you have, right? So if the price drops 10%, I had $10 and I borrowed $100. So if the price drops to $90, and then that $10 of contingency that I had, they get sent to the person that borrowed me, and that person so that person doesn't never get any risk, right? In the moment the market goes down against your prediction, your contingency is gonna cover the costs of whatever you borrowed. So that's a margin account. A margin account is where you can get borrow money and with a contingency, and you get liquidated if you get the gains if your bet is correct, but you will get liquidated if your bet goes the other way. So
Daniel, give me a second. This is getting very, very technical for the majority of people here right now, because we are talking about professional day trading here. Like, margin trading is something that is meant for professionals.
Yes, it's scary because most people, like 90% of people, lose their money, and I don't know if I'm a professional or not. I might be, because now it's like a big part of my income, but yeah, I started. I mean, I wasn't a professional when I started, right? So it's a way like to invite people if they like.
I just wanna like back up to for everybody to be on board and to have an idea in which risk area we are talking about here right now. Like,
yeah, this is a risky kind of thing.
This is like, we are already talking about crypto investments, right? Like that is this definitely like, we can argue about what is more risky, like investing into stocks or crypto. Like, there are different ideas about it, but the volatility is definitely higher in crypto. So that increases risk in general when it comes to investing. Within this high risk of crypto investing, margin trading is amongst the top risky investments. Even professional traders have a hit rate, like a positive outcome of maybe 60% of their own trades, which at the end is like awesome. They make a ton of money, but that is really, really, really risky, and it's hard to become something like this. For the purpose of our group, it is good to know that it exists. It is very easy to set it up, because whenever you have an account in Binance or whatever it is, KuCoin, I don't know if it works on Bitso as well. You can create a margin account and start doing this and leverage your trades, and it's very tempting, because the return looks awesome. But I tell you out of my own experience, like this is tough. This is tough shit. Like it's not easy to make money there.
Yes,
Sorry. So yeah, go
we
ahead.
I mean, I guess that you, Robert, have been like liquidated once in a while. I have been liquidated for some like mistakes I've made. So if you want, like, if you're interested in doing margin trades, if anyone is interested, my recommendation would be like start small, like get a little bit of the flavor of what it is, and don't, because you can do like the leverage, you can be like 20x or 10x or something like that. Don't do that. That's too risky, because if the market moves just a little bit, you'll get liquidated. But if you do like 1-to-1, right, you have this amount, $100 of for contingency, and you get $100 borrowed. So now price has to drop over 50% for your margin trade to be liquidated. And I mean, I know that cryptocurrencies are volatile, but not 50% is something that you can sort of see it coming, or if it starts like going free fall, you can put more assets into it so that you don't get liquidated. And it's a job. It's stressful when you're about to get liquidated. It's one of the most stressful like feelings you can feel, because you can I used to have, like, well, I'll show my first I've only done two serious margin trades. The one that I'm doing right now, and one that I did last year. So going to this. This is called Trading View. I think Robert had already talked about it. So going to my current long is ADA. ADA is Cardano. Is the short, like for pesos is MXN, for Cardano is ADA, and BUSD is a tethered USD to the. It's a crypto. It's from Binance, a Binance coin that stays with the dollar 1-to-1. And so this is my trade. I started off here. Well, I started off here, but I was liquidated because I wasn't careful enough. Then I restarted the trade here, and I had two limit orders. A limit order is like I set a price. I set the price like 10% below and 20% below, and if it reaches that price, it will do another long. It will borrow more money, and I did another one here. That if it reaches this price, so what am I doing? I think the price is gonna go up for Cardano. That's my belief. I think this level is gonna be it's gonna have a lot of resistance. So like to go below this level, I think it's gonna be difficult. And so like right now, only this long is getting profits. This other one is getting not profit. It's getting anti profits, and what I'm trying to do is find the lowest part. Right, there's like here the lowest part was here, and then it went up a lot. So I'm sort of trying to do that. I'm trying to find the lowest the low. I have some money to back up this investment, and I can wait like a year or whatever it has to take for this long to function. I do get interest as time goes by, but the benefits have been much greater. The other long I did before this one, that was also a strong one, was ADA versus BTC, I think. Yeah. And it was over here. So I was very like happy. I was very happy that we were having like Cardano was coming from this very big long bear market, and then it came to this a bull market. It went up, and I was very excited, whatever, and I started my long here, and then started buying more and more and more as price went down, and then price went down more, and I had to resist. And these were like one of the most stressful moments I've felt. But then I I think I liquidated somewhere like around here. I stopped the long somewhere around here. So I had to wait from here, 25 of July of 2020, and the long finished in about February of 2021, and I stopped doing these like lines because I also like I did some buying here, but most of the time here I was just saving the investment so I wouldn't get liquidated, and it hit off, right, and I'm happy, and but I didn't start another long until later, like much later, like now, because it's stressful, and I was like sort of looking for the right time, right? One of the things I learned is never do it in ADA versus BTC. Also, don't do it versus BTC. You do it versus USD. Another thing I learned is that this is me hunting for the minimum, right? All of these lines are me doing new longs to find the minimum, and these new lines are two next to each other. So in this case, if you can see, they're much more separated now because I'm getting better, I guess. And worse because I got cocky here and just didn't do the necessary calculations of when was my liquidation price and that sort of thing. I don't know if that's interesting or if anyone wants to know anything more. Or if anyone wants to talk about their own stuff, that's also very, very.
Maybe going back to the stake pools to understand how they work.
Okay. So a stake pool. So there's this problem in decentralized processes or in blockchain where you have to choose the next minter. There's blocks to be minted into the blockchain, and the problem is how do you choose the next one, right? How do you choose the next winner, the next one who's gonna get the mining profits? And that's done in Cardano in proof of stake. That's done by the stake pools. Stake pools have machines working, listening to the protocol, saying if they get if they get chosen, they mint the new code. They send it to the blockchain, and people accept it, right? Because they were the chosen persons. How do you get chosen to mint the next block? How do you get and the way that you do it is with zero knowledge proof, and this type of zero knowledge proof is called proof of stake. So if a pool owns 25% of all the stake of all the Cardano in circulation or all the staked Cardano, then it'll have 1/4 or 25% of the probability of minting the next block, and that's their work. That's how they get rewards from their work, and one as a Cardano holder can delegate their stake to these staking pools. So you can choose from many staking pools to whom to give it your stake. So that pool will have more probability of being able to mint the next blockchain, and by minting the next blockchain they get the rewards, which is what they're looking for. Carlita, you want to say something? You're muted.
Yes. Sorry. By minting the next, like if they get chosen and minting the next block, do you mean that they have to do the trailing zeros, or can it just be
not anymore? The trailing zeros is a trick that proof of work uses, because there's this thing called the cryptographic hash function that you don't know when it's gonna give you the trailing zeros, but you can like brute force it by changing the footnote like many times until you get, wow, I got these trailing zeros, perfect, I can now publish it. So it's a hard problem for any machine to do. Any machine has to try again until it gets these trailing 20 zeros. It's these trailing 20 zeros doesn't apply to proof of stake. Proof of stake does it another way. That is not energy. It's very energy efficient. Very energy efficient.
Thank you.
Any other people who want to talk about themselves or anything?
Maybe maybe to give a bit of context for like people who are new to the crypto space, how to compare staking in the traditional world. You were talking about like a 6%, 5 to 6% return annually. That is compounded, or
Compounded,
it's
of course, every year.
compounded?
Yeah.
So consider this staking similar to owning a stock and receiving dividends
Of
on it.
course. Yeah.
That is basically the essence of it. With the like, depending on how you evaluated that specific asset, in this case Cardano, you are obviously betting on a compared to the traditional market, a penny stock. Still, in the next couple of years, it's going to be different, but we're talking about betting on penny stocks and getting dividend payments off of this penny stock. You're obviously like holding this this asset because you believe that it will increase in value over time. So that should be your major goal here. You're not buying Cardano in order to stake it and get like 5% return per year. That's ridiculous, because it has higher swings every day. What you want to do is make your own research about like proof of stake cryptocurrencies. Cardano is a big one. There are other big ones out there. Cardano pays a decent reward, 5%, 6%. I mean, there are not a lot of traditional assets that give you a 5% return on top of your of the increase in value of the actual asset. And when you believe, or if you believe that the entire crypto world is gonna like boom in the next couple of years. Right now we are sitting at a 2.5 trillion, 3 trillion market cap of all cryptocurrencies. If this goes up to 10, which is not like out of discussion or something, Cardano will outperform this market. So you can easily expect Cardano to do better than 400% return, plus those interest that you receive on staking. That is kind of the mentality you should have when investing into those kind of assets.
Of course. I can also talk about Cardano in general. Like, why is it like better than other proof of stake protocols? If anyone wants to listen about more about Cardano.
Actually, like a bit of marketing about for Cardano is actually quite a good idea, because as like there are a lot of Cardano is a so-called layer one solution for in the cryptoverse. Like you have a lot of competition in this field. Ethereum is the biggest one. There are certain limitations to Ethereum. That's why Cardano basically exists. Maybe Daniel can talk about that, like why it exists and where it tries to focus on.
Okay, so Cardano focuses a lot on research. It's like the slow player. Everybody wants to like come into the game and develop fast, do the same thing that Bitcoin did, maybe with a twist like what Ethereum did, but basically the same thing. And Cardano came in and took like a very academic point of view. They paid academics that I followed like from a long time before, and to help make the basis of like to do mathematical proofs, right? Because cryptography is full of math. Cryptography have to have a correct cryptographic function implementation. You have to have a lot of math knowledge and also a lot of computer knowledge, and it's not a simple thing, right? So if one knew that their cryptographic messaging app was vulnerable to other people like spying it, people don't trust it that much, right? People trust the little candadito, the lock that goes in next to websites that they're secure somehow, and well, Cardano is very good because one, its energy consumption is one. It's academically proven that it's as secure as Bitcoin. Bitcoin is a proof of concept, and it worked, right? It's like governments tried to take it down. They tried several ways. Many governments have prohibited Bitcoin many times. China has said like once and again prohibition of it, and if Sarah, if you're talking here, you're muted. Well, and so it have been prohibited a lot of time, and it hasn't been taken down, right? So it's that type of proof of concept. Cardano takes like the soul of Bitcoin, which is zero knowledge proofs, chooses one which is proof of stake, that's like very efficient, and implements its own system. And so the academics behind Cardano are there's no other project that has better academics, right? Cardano is normally attacked because it's too scientific, too much research approach, and I think it's a good thing because it's a way of being secure, that things you won't get hacked, that your funds are gonna be secure, and like there's a lot of hacks that happen especially in if you give your crypto to a exchange, and they own. I mean, if you don't have your keys, then you don't own your crypto, right? So if you give that crypto to an exchange and that exchange gets hacked, then things can go wrong, right? Cardano uses a paradigm called functional programming to make mathematical proofs that programs will work in a certain way, so that these types of hacks can be much less applied, much less. It depends, right? It gives you the tools to make secure application, but it doesn't necessarily imply that your application is going to be secure. If I make an application in Cardano and it's not a secure application, then those funds can be taken by someone else. But if I use the tools that Cardano gives me to mathematically prove that this program is going to work the way that it describes, then it's a good thing. So one of the three good things about Cardano. One is it uses proof of stake that is much better than proof of work. Proof of work is just a proof of concept, and there's better things that the academic has taken out. Number two, it has academics behind it that are top notch. And number three, the change rate of Cardano is increasing a lot, and it's increasing a lot because all of the previous decision that they've taken. There's this thing called the hard fork combinator, which is not a hard fork actually. A hard fork is a terminology used in cryptocurrency when they change the protocol. If you have a protocol like a Bitcoin protocol, and then you want to make the block sizes a little bit larger, you have to fork the protocol. So in that moment, there's people who can stay in the protocol before it was forked, and there's people who can continue with the fourth protocol. So Cardano has a mechanism called the hard fork combinator that alleviates this problem, and the rate of change of Cardano is very, very fast compared to other. Like the amount of GitHub commits, it's much greater than any other cryptocurrency project. So that's my proselytism of Cardano, and it's treated me well, and I hope it will treat you well too. I have cousins and some friends here that it has treated them well.
I don't see any other question popping up here. Well, thank you, Daniel, for that really, really, really thorough explanation. Really, thanks.
I hope
Thanks
you
a lot.
liked it, and maybe this will be up in YouTube. I'll tell you if I do it or not.
Can I ask just one last question?
Yeah, the thing that you said, like compatibility, reverse compatibility. Yeah, this hardcore combinator is something that secures compatibility with the protocol that's a generation before, right? It's a yeah, saying hard for combinator is like a big word that might not tell anyone anything, but it's a nice thing. I guarantee it.
But another last question.
Oh yeah, of course.
If somebody were to want to try investing in it, but small, like what would you say the minimum small investment?
I think the minimum you can put into Binance is like 10 pesos. It's like very small. And that 10 pesos, maybe 20 pesos might be the minimum, because there's going to be, when you send from Bitso to Binance, you will lose some of the 20 pesos, and then you can change whatever left from those 20 pesos. I myself used to invest that way. Like, I didn't buy some beer one day and I just put 20 pesos in it. Maybe like 100 pesos, and then another 100 pesos. And now not so much anymore, but at the beginning, like 3 years ago, I did do that, and I'm very glad I did that because it treated me well.
Awesome, thanks.
Well, I think like most of the people here are family members. Just Hugo, Sara, Luis aren't. So if any family member or if any of those persons don't want to say something, now's the moment. Or we can like close the session or whatever.
No more questions.
Okay, there's one from Leo, who is my another cousin, that says that what's the difference from having your funds in Binance and in MetaMask? MetaMask is an example of a local wallet, right? If you make a wallet in MetaMask, if the wallet might live in your browser, but it's still a local wallet. That's something that doesn't live in the internet as a general thing. So you'll be the owner of your cryptographic keys. Anyone who has made a wallet knows that when you make one, they give you keys. There's a list of words, like 20 words or something, most of the time, and those keys are those words are the private key, are your private key that you have to maintain secure and secret, and you can restore that wallet with those when you have your money in Binance, they own those words. Those words, you're not the owner of those words. So if you want to restore your wallet in a future time, you won't be able to, because you won't have the words. They will be able to do it, and if they get hacked because they mismatch your words, then your money is gone. And many people have lost their money this way. That's why you should have your money, your crypto. Everyone here should go, if you don't have your money in at least most of it, because I also have some money in Binance because I use it for the margin trades, but most of your money should rest in your wallet, and your wallet you should have your words secure, maybe memorized, which do keep your funds secure by having it in a wallet and not in an exchange. It also makes the if everybody has their money in exchange, it's worse for the protocol, because we don't want wallets that are very big, especially in proof of stake, because if a wallet gets too big, they get too much probability of getting a block mint, right? And I don't want to like Binance to be like the one who gets most of the things. We want like everybody to get a little bit, right? I don't know if that answered, Leo, your question. I hope so. Any other comments or whatever? Well, then I think I'll stop the recording here, and